You go through school, you get out. Now it's time to start paying off that debt that accumulated, that you borrowed to pay tuition and expenses. The deal is with the federal programs, if you don't do anything after you graduate, you have this forbearance period, which means that you don't have to pay them back the day that you graduate, but you do have to pay them back soon afterward. And I can't remember what the standard forbearance period there is. It may be 3 months, it may be 6 months. But once that window closes after you graduate, it's time to start paying these loans back. And the default amortization period on federal student loans is 10 years. So if you don't take action, you don't do anything, the servicer for your loans is going to figure out what payment you need to make what monthly payment you need to make over a 10-year period, so that when the 10 years is up, the loans are extinguished. It's a fixed rate, just like your mortgage and any other kind of debt, and the rate is generally very, very high, all things equal. So it is tempting to take a look at that right when you get out of college and say, holy smokes, I've got $100,000 of debt at 7.5%. Aren't interest rates really low right now? Shouldn't I want to refinance that and get a better rate? And the answer is sometimes yes. You could absolutely go to any private lender. There are a bunch of private refinancing outfits in the student loan space these days. Laurel Road, SoFi. There are a bunch of others, but if you Google one, you'll have about 10,000 ads pop up at you to give you the full list. The deal is, yes, you can absolutely refinance out of those loans with another lender and get a better interest rate. So just like any other refinance, you fill out a bunch of paperwork, information about your loans, they check your credit, you sign at the bottom line, the lender pays off what you owe the federal government, and now you owe that new lender. And so the attractiveness there is that you're paying a lower rate. And if the path for you is to extinguish these loans by paying them down and paying them off as quickly or as slowly as you want, then that is usually the best route. But, and this is a big but, when you leave the federal student loan system, you are foregoing substantial accommodations. There are a lot of benefits of staying in the federal student loan system. Yes, you're paying a higher rate, but I'll give you a couple of examples of where this really makes sense to stay in that federal system and not refinance privately, even if it saves you some interest. The first is that the default amortization period here is 10 years. So you've got $100,000 of debt. Let's say you're paying 7.5% interest on that. The servicer is going to figure out how much you have to pay each month to pay that off. And I could do the math on that. I have my calculator in front of me, but I'll spare you all the few moments it'll take me to do that. Let's just call it $1,000 a month payment is what you have to pay, given those inputs. Well, the federal system, each president that comes along seems to understand that student loan debt is a big deal. A lot of people have it. A lot of people have a lot of debt, and it's really a hardship on young people to get their lives and careers going, and it's a drag on the economy. So they want to introduce legislation that helps them. And it seems like every new president over the last 3 or 4 has created a new income-based loan repayment system that's been tacked on to previous systems. So I say that because if you don't do anything with the loans coming out of school, it's a 10-year amortization period at the rate that is already on your loans. But if that $1,000 a month or whatever the payment is too onerous, you can enter one of 4 different income-based or income-driven repayment systems. And the idea is the monthly payment you make is not based on the what payment it will require to extinguish the loans, pay them off in a certain period. The monthly payment you make is based on your income. There are 4 of these programs. The oldest one is called income contingent repayment. It's less popular because it's not as favorable. The next one that came around after that was income-based repayment, or IBR. And there are two forms of this, old IBR and new IBR. Then there was pay-as-you-earn. PAYE is the acronym there. The most recent one, which I believe was an Obama-era regulation, is revised pay-as-you-earn, or repay.